Well, hello, you fabulous interior design professional. Welcome to Business of Design. I'm really glad you're here. And we're going to talk about one of my favorite topics, and that is making money. Specifically, we're going to talk about some of the key metrics that you want to be paying attention to that will help you determine the state of health your business is in. You don't have to trust your gut. You can rely on data that can give you great advice. It's a conversation we've had before. It's a conversation we'll have again. The guest we had today was wonderful. I hope to get him back on the show again. Nolan Bradbury. He's the founder of Bradfield Accounting and Advisory. He's a seasoned financial professional who's passionate about helping business owners achieve their dreams. He's got 2 decades of experience, both private and public sectors, and he helps entrepreneurs minimize the unknown and remove operational uncertainty from the equation so they can do their best work, so they can lose less sleep, and so they can increase profitability and cash flow. So our missions are very much aligned. There's no question about it. You can find Nolan on LinkedIn at Nolan-Bradbury. Go to the show notes. Also, his website is bradfieldco.com services, and he's got a free self-assessment there, how to accelerate your profits. I can't see enough good things about developing a relationship with someone who can help you on a monthly basis and more frequently. Keep an eye on the most important numbers in your business. Once you gain that mastery, it's so empowering. And then you can move on to other things like focusing on how to grow independent wealth and managing investments. I feel like I'm getting to the next level in terms of investments for the first time in my life, which is really exciting. I also know that Business of Design is going to be relaunching its Business of Design Elite Retreats, and we are going to focus in large part at the retreats on financial results. And we are going to ask for some of your key metrics, and we are going to use those metrics and show you how you can take advantage of them to be more profitable. We don't have the details quite yet, but maybe Cheryl on the announcements will tell us a little something about what's coming up. And as usual, you're definitely in the right place. Thank you so much for being here. And quick announcements from Cheryl, and we'll get right into the show.
Thanks, Kimberly. Well, since you already mentioned it, let's start there. In October 2025, we are bringing back Business of Design's Elite Retreat, and we are headed to Santa Monica. So we have just added it to the website. Not a whole lot of details there yet, but we do want you to save the date, October 16th to 19th, 2025. And I have just included my email address on there. If you are interested in learning the details as they become available and you want to know as soon as registration opens, please shoot me an email. We are going to create a bit of a wait list and as we start planning for that. But again, save the date October 16th to 19th, 2025. And then jumping a year ahead, this October, we're going to be celebrating 20 years of Business of Design at High Point Market. And then even sooner, coming up this week, Wednesday, June 26th, is our next BOD Live member meeting, and we're going to be talking about a hybrid model contract. So I know we've had a lot of interest in that one. If you are a member or looking to join, it's a great time. Please participate in that meeting. All you have to do is click through to your member dashboard to join us, 1 p.m. EST. We hope to see you there. Details for all of these events, as always, are at businessofdesign.com in the events section. Thanks so much.
Nolan Bradbury, nice to see you.
Nice to be here. Thanks for having me.
I think what's hilarious about this is I'm actually looking forward to the conversation. And why that's funny is because, I used to do anything I could to avoid conversations about finances and accounting and bookkeeping and these subjects which sounded so daunting to me when I first launched my business. I'm not alone, right?
you are not alone. This is actually, I would say, the mission I'm on is to sort of, one, remove the fear that often exists for business owners when it comes to the things you just mentioned, but also explain why that can have a negative impact on our business and what we can do about it to help utilize accounting in a really more positive, effective manner.
I love that. And I wish I had met you, 30 years ago, because I spent so much time avoiding it. And when I finally just had to eat the frog, or whatever term you want to use,
Yeah,
it really wasn't as complicated as I had thought. And the information you can get is so helpful, right?
absolutely. Yep, you nailed their head right on.
So we talked as we were, introducing ourselves to each other before the show began about how we really want to keep this actionable for people. And one of the things that stuck out for me in your application was this idea that perhaps focusing on the P&L is a bit too much for people, but there might be some key performance indicators or KPIs that can simplify the process. So why don't we just start there? Like, let's
Yeah.
convince people who are listening that this is not just an eat your vegetables episode. It's going to be like good for you and it's going to
Yeah.
be okay.
Absolutely. So let me preface and explain why I say that, and then I'll kind of answer the question head on if that's all right. So I think it's important to understand what the financial statements are really representing when you look at them, because I think for a lot of people, that's not something where, unless you're an accountant, you aren't necessarily understanding the nuances of it. So just to kind of baseline everyone, there's two, three-ish, maybe primary sets of financials. You have your balance sheet, you have your P&L, and you have your statement of cash flows. Okay. If you ask an accountant, they will tell you the most important of those three is actually the balance sheet. Now, I will spare going through that in a great detail, but the reason for that is it is a life-to-date representation of how your business is done. So it is like from beginning of inception to today, it shows you all the activity. Okay. The P&L, when you run it, is looking at a specific period of time. And by and large, a lot of what you're seeing is geography. So what I mean by that is you have revenue and you have expenses. But where it shows up and where people get really hung up in looking at the P&L is like, well, what is it classified? I don't want to say it doesn't matter because there are certain exceptions to that when it comes to tax deductions and so forth. But by and large, where you put something as a supply versus a cost of goods sold, that's really more informational for you. And so what I find oftentimes is that one, the P&L becomes very muddied for businesses, meaning that it has way more detail than it really should have. As a result, it becomes way less meaningful for people. Like in an ideal world, you want to be able to look at a P&L in one page, and you should be able to understand how a business operates by looking at it from the top to the bottom. Now, for most people, that still doesn't necessarily help them answer the question of like, how do I strategically make decisions for my business? How do I know that it's performing where it should? And so that's where I tend to help people focus more on pick 3 to 5 metrics or key performance indicators that you understand and are representative of your company, such that when you look at them, you have a good pulse on whether or not things are where they should be or if they're getting off kilter. I sort of think of it as, and this is an old timey reference here, but it's like the canary in the coal mine, right? They would put it in the cage, and if it was alive, there was enough air down there. If you saw it falling over on the bottom of the cage, you're like, uh-oh, there may not be enough air. We need to get out of here. That's kind of the same idea with KPIs. They're not meant to be precise measures. They're really meant to be, is the business trending in the way that I should be relative to what I understand my business to be? And part of designing those is reflecting how you view the business. So this is the other key piece is that for a lot of people, the financials, and I'll say the P&L and other components of it, they're written by accountants for accountants. Well, if you're a business owner, you're not an accountant, that's not all that helpful, right? It's kind of like reading a second language to you. But when we design KPIs for you, they're often more reflective of who you are, how you view your business, how you run your business, and thus they become even more meaningful, not just in the sense of like simplifying down what you're looking at, but also being more tailored to you personally.
Okay. And when you do that, then of course you're going to get excited and engaged in the process a little bit quicker and get that
Yes.
relationship going with a financial person, which, is just invaluable when you find the person that you can talk to and who makes it come alive for you and all that kind of stuff. What are some of the key metrics we should even be considering then? Let's assume that somebody listening has
Mhm.
really been like I was years ago. So they've stuck their head in the sand. Let's
Mhm.
start with the beginner, and then I want to make sure we include something for those people who feel that they're more savvy. But for the beginner, what are those KPIs?
Yeah, so I think that's a good place to jump off to, because I think sometimes when we think of KPIs, oh, it needs to be this very sophisticated measurement or calculation to arrive at something. That isn't really the case. KPI can really be anything. So for someone starting out, it may be something as simple as what is your cash reserve on hand? Meaning how many months of reserves you have if there was a dry spell in your business or things took a turn or something in the economy really happened. So maybe it's something the KPI is as simple as you have 2 to 3 months of expenses sitting in a bank account someplace, or maybe even more simply, what is your total cash available to you on hand, both in an operating and a savings account? That does qualify as a KPI, and it can actually be very meaningful for you in terms of understanding when I need to make this decision, that maybe you need to go hire someone. Do I have the reserves to sort of stem the initial cost increase that I'm going to have relative to hiring that person, right? So that's a very sort of baseline example of what a KPI might be for like a very sort of simple outlines from that perspective. Okay.
So since you introduced that one and you said,
Yeah.
you're looking at your cash on hand and you see that you
Yeah.
have 2 to 3 months to hold you over in the event of who knows what, I immediately think that's not enough. It's probably because I worked for myself since I was 14. And I remember 2008 when we went from 30, design build projects to like 2 bathrooms in an
Yeah.
hour. I kind of feel like 6 months is better, but again, is it just it's got to be a personal decision based on
Yeah.
your needs and all of that?
So great question. So just to clarify, I'm not suggesting 2 to 3 is the number you should have, more of as an example of it. And so I start with 2 to 3 because if you're starting from 0 and I tell you you need 6 to 8, that's a very overwhelming thing for me to tell
Yeah.
you, quite honestly. And when we get to that place, we start to resist it because, oh, that's so far away, I can't do that. And we're less likely to lean into it. I prefer to sort of set very incremental goals because success breeds success, in my opinion. So if I say, hey, start out, just get 1 month of reserve. Okay, you can get 1 month of reserve. When we get there, now let's go to 2 to 3 months of reserve and let's start moving the goalposts a little bit and keep getting to the place where we actually need to get to. I think that if you start out and go like, hey, you need 12 months, 8 months of reserve, the odds of you hitting that in that amount of time, it shrinks significantly. So just to clarify the point, so it's a great question. I agree with you. You do need more than that in reserve. I think to start off, especially if you're starting from 0, I think aiming for something greater than that, I think you're setting yourself up for a bit of failure.
Okay, fair enough. I get that. All right. So that's an initial kind of one.
Yeah. So then I think where I would say maybe as you start becoming more sophisticated and things that will sort of help you understand how your business is performing from an efficiency standpoint, I would start to look at sort of what we refer to as comparative ratios, meaning that what is the cost of your, let's say, cost of goods sold relative to your revenue, meaning like how efficient are you with each dollar you're earning to what you're keeping. And so that's indicative of like how well are you maintaining your costs as the business scales or holds steady, right? So one of the things to think about is the way you make money, and we're going to name that as profit at the end of the day. So net profit at the bottom, right? I think as business owners, we often get hung up on the idea of revenue. Revenue is great, but that's a top line number. That's not actually what we get to take home, right? We take home after we paid everyone what's left over.
I wish I
So
could take home revenue. That is one of my
wouldn't that be
fantasies.
wonderful? Yes.
Yeah, that would be great.
It would be a lot easier if we did that.
Yeah.
But when we think about profit, there's really only a few ways that we can make ourselves more profitable. Okay. So we can either sell more work, right? Which in that case increases top line revenue. We can spend less, which is we cut back and we spend more, less going out the door, which means we make more at the bottom of the day. Or maybe we have a little bit of both, right? That's the ideal scenario. But those are really the only levers or mechanisms that truly directly impact our profitability, right? So when we're looking at as we scale, maybe as we add more revenue or as we sort of hold steady with where we're at, we want to increase our profit. We have to do something in tandem with it, right? So if revenue is going to hold steady, we have to reduce costs. If revenue is increasing, well, we don't want expenses to increase at the same rate because otherwise now we're just working harder and making the same or even worse, less in that scenario, right?
I've been there.
We've
You
all
can
been
do
there in
that
some
by
capacity.
over hiring, right? Like you can
Yep.
have too many staff and not
Yep.
enough reins
Yep.
on them and find yourself in that exact position.
Yeah. And, sometimes it's okay in the short term, right? As you're ramping up, right? If you know you have some project coming up down the road and you're like, I need to get to this point, totally understandable in the short term that you would see costs increase in preparation for that, right? But as we're looking at a business over the long term and you're trying to scale this business to get to a very high level of profitability, you don't want that to be the case, right? You want a lower cost to revenue ratio, if you will, right? So that's what we're kind of talking about is that's a good sort of level check, gut check, if you will, as you're driving the business along. Are costs getting out of control? Are they increasing at a too fast of a pace relative to what I'm generating in revenue coming in, right? So that's kind of a bit more of an advanced metric in terms of really looking at like the ratio of things. And then I would say beyond that, then you start to get, I'll say, more nuanced or specific types KPIs, where maybe you're looking at a particular offering within your business that's really keyed in, like what are the costs associated with this particular type of service or revenue that I'm generating? How is that leading out? Because in some cases, some businesses have, well, not like lost leaders per se, but less profitable businesses or lines of business, which they're okay with. so long as the other more profitable work is being generated off of that in some case, right? It's sort of a lead-in offering, if you will, in some cases,
Hmm.
or a tag along or an add-on, as the case may be. And sort of as a business owner, understanding and making sure that those particular offerings are as profitable as you think they are. One of the most common areas that I see businesses get out of whack is when they're allocating resources, either time or money or both, to a product or an offering that is not as profitable as they think it is. This is a real easy place to sort of go sideways, because you start putting more money into the marketing side of things, you'll start putting more money into that people side of things, and all the while you have this other line of business or offer that's doing not nearly the level, but is generating way more profit relative to what's being generated, right? So that's where that type of KPI can really help you hone in and go like, am I focusing on the right aspect of my business and not sort of just throwing something that I think is the best thing?
So to give maybe an example that everybody can visualize, we had this experience when we found ourselves in actually the end of 2008, 2009, just doing kind of kitchens and baths.
Mhm.
And we got busy doing kitchens and baths. And I thought, gosh, this is kind of easy. Maybe we should just do kitchens and baths. But when I analyzed the profitability of kitchens and baths against the profitability of decorating a living room, for example, or a dining room, there wasn't the same profit. There just wasn't. And the work is hard and complicated. And I thought, that's interesting. So you're right. So then I guess if I hadn't been checking in with the data, I might have doubled down marketing efforts to get more kitchens and baths, not
Exactly right.
realizing that I was actually aiming for my lowest profit introducing business, or however you want to put it.
Yeah.
The thing was less profitable in my business. Yeah.
That's a great example, because that's exactly what we're talking about here, right? Is like, oh, this is really easy. Like I got a lot of this business. But sometimes as business owners, we sort of stumble into these things and then we're like, oh, this is great. And we never stop to look at the numbers and go, is this really the thing I should be focusing all my time and energy on?
Mm.
Is this generating like 10 cents on every dollar, or is this generating 25 cents on every dollar that I'm like working? Because to your point, if it's really hard work, is it actually paying off for you in the end, right? Not all work is equal at the end of the day,
Mm.
not just from a dollar perspective, but in terms of the amount of energy, time, mental that you're contributing to getting that project done.
Yeah, interesting. Okay. All right. So give us another one. We got a pen's
So
handy.
Yeah. So I think now, at this point, we've identified about three different types of metrics that we're looking at, right? So if you're going to do more than three, I would say no more than five. And so the remaining ones I would say really should be tailored to your specific business and maybe I'll say nuance to how you view the business. So maybe this is you have a particular cost line in your P&L that is particularly focused on, meaning that it fluctuates up and down a lot, or maybe there's a lot of recurring expenses in that. That's one that I might call out and go, let me look at this every month and let me make sure that this is not getting too far either direction, meaning that it's staying in line with where I need it to be.
So
It
that
might be,
could
yeah,
be
go ahead.
like wages, like if you have independent contractors you're working
Independent
with,
contractors is
or
a great one, right? So making sure that if you're hiring them to do specific projects, that like you're looking at that and making sure that that's in line with sort of when the work is coming on board, or that just that sometimes like, and I'll say this maybe in a different one, like software is one that I see a lot of people sort of they
Mm.
sign up for software, and because a lot of things are subscription now, we tend to kind of set it and then forget about it. And then 6 months have gone by and you spent $150 a month on something you used like three times. That's a
Right.
really common one that like is one where you kind of keep an eye on it and make sure that it doesn't get too bloated or inflated with things.
Yeah.
Um, and
But
then, the
not your Business of Design membership. Don't touch
that's,
that.
that's exactly
Right.
right.
If you're
That is,
only checking in 2 or 3 times, then you're not working on your business enough and you need to cut it out. But I know exactly. I know designers who have like 10 different software that they
yeah.
use for like this portal and that portal and managing teams. And it's like, I don't know that you need any of that as much as you need to focus on being profitable in the different categories in your business. Like
Yeah.
just quit it all and get down to basics.
Unfortunately, as business owners, we fall victim a lot of times to like the shiny object syndrome, which is
Yeah.
something new sort of flashes in front of us. So like, oh, that's really cool. And like it catches our attention for a little bit. And
Yeah.
until the next thing comes along. And then we have this sort of accumulation of shiny objects that are no longer shiny to us, but we're still spending money on them.
Yeah.
That's like we don't want that to happen. But it happens to everyone. And so that's where it's important to have some sort of mechanism to sort of act as a a check and balance against that sort of getting out of hand, right?
And again,
The
those numbers, you have this data available to you, but if you're afraid to look at it, you're not getting the
exactly,
benefit of what it's telling you every month, every
exactly.
week.
And so the last one I'll throw out that maybe is one more widely applicable to everyone is probably something around the rate at which you're collecting on payments. Okay, so I'm not all businesses have a little bit of a different philosophy in terms of how they make money and when they collect it. Sometimes you charge a deposit up front and you collect the rest at the end. Maybe it's all up front. Maybe you're sort of milestone based in terms of collecting things over time. I would say a really good thing is sort of looking at how much money are you bringing in, say, on average across 30 days or the last 30 days for that? And so kind of making sure that that doesn't start to drop too quickly. So this is a real good leading indicator as we talk about, meaning that it's telling you something that could be coming down the pipeline. So if your collections are holding, and then you start to see that ratio dropping, that's where we want to look at and go, well, maybe the canary hasn't fallen to the bottom of the cage yet, but it's definitely starting to get a little woozy. We should probably start looking at why is the collection starting to slow down? Is that because maybe we don't have the projects lined up that we thought we did? Do we have a particular client who is perhaps behind or delinquent in paying us? These are things where you really want to pay attention to these because you've already done the hard work, which is getting the job done. Maybe you're already working on the work itself. Don't let a client not paying you be the thing that keeps you from being profitable, being able to pay your people, right? So some things like that sort of help make sure that you aren't being held hostage by your clients is another thing right there. So I think that can be oftentimes another nice KPI for people to be tracking.
Should you be able to, I mean, I guess this is a silly question. You should be able to talk to your financial person and say, help me figure out how to get started in looking at these numbers a priority in my life. And then
Yes.
do you build slowly? Do you ask for small reports to come
Yeah.
to you each month? How do you suggest people get started?
Yeah, so I can speak to this more from how we work with clients, just because obviously that's what I'm I'm familiar with. So oftentimes what we start with is, believe it or not, what we want to is understand what the client's current relationship is with their finances and their money. It oftentimes isn't great, to be honest with you. Either
Yeah.
they've been burned by a previous bookkeeper or CPA, or maybe they've been talked down to. One of the things we were kind of talking at before this, right, was how there aren't really college courses you can take that teach you like how to run a business and read financials from a leadership position in a lot of
Right.
cases, right? And so as I mentioned, accountants design financials for accountants. Well, what ends up happening is we as a business owner want to engage maybe, but the information we're getting doesn't really allow us or invite us into a conversation, right? And
Mm.
so what we want to understand up front as the accountant in this role is, how do you view the data? Are you a visual person? Do you like tables? Do you like charts? Do you like colorful displays? Would you rather just have a short Loom video that explains to you what's going on? There's no wrong answer to this. It's what's going to work best for you. As a quick analogy, it's like, what's the best diet? It's the one you're going to stick to most often, right? It's what is the thing that's going to keep you on the process? Because that's actually the most critical piece of this. It doesn't have to be perfect. It just has to be something you'll stick to and be consistent with. Because to your point, what we're going to do is over time, we're going to start nailing in and dialing down what the pieces are that you need to. So early on, we'll start with one or two maybe key pieces, and we want to simplify it if someone's not super comfortable in that idea of the financial realm. As they start to become more confident, because what we're showing them is easy to understand, it's engaging, and they can start to see the value in understanding these pieces, then they start to lean in more to this process, and then we can
Yeah.
start to teach more and add more complexity until we get to that place we really want to be at. Kind of like the idea I was talking about with reserves, right? If I tell you right out of the gate, we're going to pick 5 metrics and you're going to look at them every month, that's not really engaging you in the way that we want to, right? We want to make it a much more inviting process. And so I think that's the big thing is, when you talk about, if you want to have a relationship with your advisor, whatever advisor that is, right? You actually have to view it as a relationship. So you have to think about, like, how does this person communicate with me? Do I understand them? Do they talk in a way that makes sense to me? Can I, like, it sounds silly to think about these things when it comes to hiring maybe an accountant, but the reality is it's just like a relationship like everything else, right? So, is texting important to you rather than email? If so, find an accountant who is open to texting. Not every accountant is going to be able to, right? Because then when you find the right person to have a relationship with, having these things that we just talked about become much easier to have a conversation about, because you actually have a relationship with them, not some sort of like once a year type setup where you talk with them at tax time after the fact and you're giving them some numbers. I hate to tell you, that's not a relationship. That just
No,
isn't. That's a transaction, and there's nothing wrong with that. But if you're looking for a relationship and that's what you have, you're going to be disappointed.
right,
Even if the person is the best CPA in the world, you're going to be disappointed because what you want from the relationship is not what's being given and
right.
reciprocated to you.
Yeah, that's really good advice. I know at the beginning of the show, I said, give us some key metrics that would work for somebody who's really a beginner. And
Mhm.
I said, I didn't want to forget that person who feels like they're really savvy. When you
Yeah.
get next level and maybe you're a little bored with your numbers and interaction, is there something like we can geek out on that gives us some nuanced information, maybe?
Yeah. So when we have clients that sort of graduate out of what I'll call more the compliance level of support that they're looking for, right? And they move into more the advisory type support that they're looking for, which is a bit more, it's a relationship on a more frequent basis, if you will, right? It's the level of proactivity that you're increasing. I would say in those cases, what this is where sort of the more sophisticated business owner really, I think, would benefit, which is you start having more in-depth conversations about everything, right? So what we talked about was very surface level. We talked about 3 to 5 KPIs. I would say if you're at that more sophisticated level, you still want the KPIs, but what we're adding around it is going to be broader and more enhanced. We are actually going to start looking at the P&L. We are going to start looking at the balance sheet, and we're going to teach you how to read those and how they flow into one another so that you are getting a more, I really don't like this word, holistic perspective of your business, right? The metrics are meant to be a kind of a quick and dirty analysis for the entry person to sort of key on. They're still there to serve a value when you become more sophisticated and your business becomes more complex, but they alone at that point are not going to be sufficient. You're going to have a more robust conversation, and the frequency at which that's happening is going to have to increase as well.
Okay, good advice. We love to end every episode with something we call design intervention, which is just a great piece of business advice you want to make
Yeah.
sure everybody gets.
So I've been blessed to be told a lot of advice over the years, and maybe that's because I've made a lot of mistakes. But the one that stuck out to me when I was thinking about this is that other people don't think about you as much as you think they do, if you will. So what I mean by that is that I think both as a human and as a business owner, we have this idea that because this is what I do all the time, that and I think about it all the time, that my client thinks about it all the time. And what we have to sometimes remind ourselves is they're getting 50 different emails within a few hours on a
Yeah.
variety of topics. And so what we have to think about is how do you want your message to cut through all of the white noise that's going through on their end, and also not assume that what you tell them is going to resonate and hit the first time. So
Right.
I think it's really critical that you don't, and it's not because you're not important to them. It's just that they have a lot of people. If you're one of 7 people in their lives who's working with them, they're all important to them. They've all
Right.
hired this person, right? So
Yeah.
it's not actually a reflection of you. It's just the reality of the situation, which is it's a one-to-many relationship. And in this case, you're the many. And
Right.
so I think that it was always valuable for me, like when I'm dealing with a client, I'm like, why can I not get a hold of this client? They told me this is what they wanted. Why are they struggling? Why is this relationship not where I think it should be? I start to, instead of look at and blame the client, I start to go, well, what is it about the relationship that maybe I can take a different approach to? How can I meet them at a different part of this process so that maybe they
Mhm.
can feel more engaged and can meet me? So the other piece I'll add to this is when you haven't heard from someone in a while, right, which is oftentimes where we feel like someone's not being proactive or following through on what we need them to be, they know they aren't responding to you in a lot of cases, right? They see the emails piling up. It's not that they don't see them, they just haven't responded to them. The reality is that you have to find a place to meet them when they're not engaging with you. Because again, it's not that they don't care about you or they're not thinking about you. It's just that there's so much other noise going on in their lives that you aren't the only person that's reaching out to them. And I think that's been
Yeah.
really helpful for me in terms of having healthier relationships with my clients and sort of keeping that in perspective.
Yeah, don't take it personally, right? Like
Exactly.
that's the thing. I don't know if this is apropos or not, but the New York Times is running currently a feature on how to keep your friendships vibrant. And the tip that they shared today was to repot your friendships. In
Well, that's a
other
good way
words,
of
if you
putting it.
have, if you have a friend that you go for dinner with all the time, shake it up and ask them to go for a walk instead. And that's true of clients also, right? Like
Yeah.
repot those relationships a little bit can be really,
Yeah.
really smart. Okay, excellent, great conversation. Thank you so much, Nolan. Loved
Thanks
every
for having
minute
me.
of it. And
Yeah.
hope life is good where you are in Seattle.
Yeah. Hopefully the renovation stops on your end as well.
I know, right? All right, bye for now.
Bye. Thank you.